Something important is happening across global financial markets, and it's unfolding faster than most people realize. While headlines continue to focus on short-term volatility, smart money is already adjusting positions beneath the surface. Interest rates remain elevated, with the U.S. federal funds rate holding near the 5.25% to 5.50% range, creating pressure across equities, housing, and debt markets. At the same time, U.S. Treasury yields remain unstable, with the 10-year yield hovering around the critical 4%-4.5% zone, signaling uncertainty rather than confidence. These are not normal conditions. They are warning signals. When rates stay high for too long, liquidity tightens, borrowing slows, and capital begins searching for safer ground. At the same time, inflation may appear to be cooling on paper, yet real-world costs continue to rise. Energy prices fluctuate, food costs remain elevated, and everyday expenses refuse to return to pre-crisis levels. Gold has quietly responded to this environment, holding strong above key psychological levels near $2,000 per ounce, while silver continues to build pressure around the 23-25 range. These are not random numbers. They represent zones where institutional interest historically increases. When traditional markets struggle to provide clarity, capital often rotates toward assets that preserve value rather than promise growth. Meanwhile, global markets are sending mixed signals. Equity indices move higher one week and pull back the next, revealing uncertainty rather than confidence. Oil prices remain sensitive to geopolitical tension, hovering in the $70-90 per barrel range, reflecting fragile supply chains and political risk. Currencies are also shifting, with the US dollar struggling to maintain dominance as global debt expands. None of this points to stability. It points to transition. This is where smart money begins to act differently. Institutions don't wait for clarity. They position themselves while uncertainty is still misunderstood. They look beyond daily headlines and focus on structural changes. And right now, those structures are shifting. When markets reach this stage, where rates are high, confidence is fragile, and volatility becomes the norm, the biggest moves often come without warning. The question is not whether change is coming, but whether you recognize the signs while there is still time to prepare. When markets begin to shift, the first signs rarely appear in headlines. They appear in behavior. Smart money doesn't chase momentum. It studies imbalance. Right now, that imbalance is becoming increasingly visible across multiple asset classes. Large institutions, hedge funds, and central banks are quietly adjusting exposure, not with dramatic moves, but with calculated repositioning. This is the phase where capital flows begin to tell a story long before prices fully reflect it. While retail investors debate direction, long-term players are focused on protection, liquidity, and assets with real-world value. One of the clearest signs of this shift is the growing preference for hard assets and defensive positioning. Gold continues to attract steady institutional interest, holding firm even as bond yields fluctuate. Silver, often more volatile, is beginning to show early accumulation behavior. Tight trading ranges, rising delivery demand, and declining available supply. These are not random movements. They suggest preparation. At the same time, capital is quietly moving away from overvalued growth assets that depend heavily on cheap money and endless liquidity. When the cost of capital rises, speculation fades, and discipline returns. We are also seeing increased activity in currency hedging, with the US dollar facing pressure from expanding deficits and rising interest obligations. Global investors are diversifying exposure. This doesn't mean abandonment, it means caution. Capital seeks flexibility during uncertain periods, and diversification becomes a survival strategy rather than a growth tactic. When multiple financial systems begin adjusting at the same time, it signals a broader realignment rather than a temporary correction. Another key indicator is behavior within the bond market. Yields remain elevated, yet demand fluctuates unpredictably, reflecting hesitation rather than confidence. Investors are no longer comfortable locking money into long-term commitments without clarity. This uncertainty creates a ripple effect across equities, commodities, and currencies alike. It's a reminder that markets are not driven by optimism alone. They're driven by trust. And right now, trust is being tested. What makes this phase especially important is that it rarely lasts long. Periods of quiet repositioning often precede decisive moves. Smart money understands this and acts accordingly. Slowly, deliberately, and without noise. The average investor often doesn't notice until momentum becomes undeniable. By then, opportunity has already shifted. Recognizing this transition is not about predicting the future. It's about understanding the present with clarity and perspective. As this transition unfolds, one of the most overlooked forces shaping the market right now is pressure, not panic, not fear, but sustained pressure building across multiple systems at once. Economic cycles rarely break from a single event. Instead, they bend slowly under accumulated weight until a tipping point is reached. That pressure is now visible in rising debt burdens, tightening credit conditions, and a growing gap between asset prices and real economic productivity. Governments continue to spend aggressively while revenues struggle to keep pace, forcing central banks into difficult positions, where every decision carries consequences. At the same time, consumer resilience is weakening. Higher interest rates are beginning to impact spending habits, borrowing activity, and corporate earnings. Credit card balances are rising, defaults are ticking upward, and savings buffers built during earlier stimulus periods are shrinking. These shifts may appear gradual, but history shows that once momentum changes direction, it accelerates quickly. Markets don't adjust in straight lines. They move in waves, and the current wave is gathering strength beneath the surface. Meanwhile, financial markets are sending mixed signals that reflect this uncertainty. Equity markets continue to show strength in select areas, but participation is narrowing. Fewer stocks are driving gains, while many others quietly lag behind. This divergence often appears near turning points, where confidence becomes concentrated rather than broad-based. At the same time, volatility remains suppressed on the surface, masking the underlying tension. This combination, calm markets with rising structural stress, is often a precursor to sharper movements ahead. Another critical factor is the global synchronization of risk. In past cycles, regional weakness could be offset by strength elsewhere. Today, economies are more interconnected than ever. A slowdown in one region quickly transmits to others through trade, currency flows, and financial markets. This interconnectedness amplifies both opportunity and risk. When confidence weakens, it doesn't stay contained, it spreads. That's why positioning has become more cautious among institutions that think in years, not quarters. What makes this stage particularly important is that it doesn't announce itself loudly. There are no sirens, no obvious crashes, no dramatic headlines, just subtle shifts in behavior, capital movement, and sentiment. This is the phase where awareness matters most. Those who recognize the signs early can adjust calmly. Those who wait for confirmation often find themselves reacting under pressure. And in markets, reaction is rarely rewarded. As these pressures build beneath the surface, the global financial landscape begins to reveal a deeper transformation. This is no longer just about markets, reacting to data points or central bank announcements. What's unfolding is a structural shift in how capital flows, how risk is evaluated, and how stability is defined. Nations are reassessing dependencies, corporations are reshaping supply chains, and investors are quietly questioning assumptions that once felt unshakable. The world is moving away from an era of easy money and predictable growth toward one defined by strategic positioning and resilience. Central banks find themselves in an increasingly narrow corridor. Lowering rates risks reigniting inflation, while maintaining high rates strains economic growth and debt sustainability. This balancing act leaves little room for error. As confidence in traditional monetary tools weakens, alternative stores of value begin to attract attention, not as speculation, but as protection. This shift doesn't happen overnight. It unfolds gradually, often unnoticed, until it becomes impossible to ignore. History shows that periods of monetary transition tend to reward those who understand the difference between liquidity and stability. At the same time, global trade dynamics are changing. Supply chains that once prioritized efficiency are now being redesigned for resilience. Strategic resources are being reassessed, reshored, or secured through long-term agreements. This has implications not only for production, but also for pricing power and resource allocation. When nations compete for stability rather than growth, the definition of value itself begins to change. Assets tied to real-world utility and limited supply gain relevance, while those dependent on leverage and optimism become more vulnerable. Technology and geopolitics further complicate the picture. Innovation continues to accelerate, yet it also amplifies competition for materials, energy, and capital. Political uncertainty adds another layer of unpredictability, influencing trade policies, currency relationships, and investment flows. In this environment, traditional correlations weaken, and historical assumptions lose reliability. Markets begin to move in less predictable ways, driven more by strategic necessity than by sentiment. This convergence of monetary strain, geopolitical recalibration, and structural change marks a turning point. Not a collapse, but a realignment. It is during these moments that long-term trends are born. Those who recognize this shift early can adapt thoughtfully, while those waiting for clarity may find that clarity arrives only after opportunity has passed. The world is not falling apart, it is rearranging itself, and understanding that distinction is what separates preparation from reaction. What defines moments like this is not chaos, but quiet alignment. History shows that the most significant financial transitions rarely arrive with loud warnings. They begin subtly, with small shifts in behavior, cautious positioning, and quiet confidence from those who understand what's unfolding. Right now, we are standing in that exact space. The signals are not dramatic, but they are consistent. Capital is becoming selective, risk is being reevaluated, long-term thinking is returning to a system that spent years rewarding speed over substance. This is the phase where awareness becomes an advantage, not because it guarantees outcomes, but because it allows for perspective. Markets reward patience far more often than they reward urgency. When sentiment swings wildly and narratives change weekly, clarity becomes a rare asset. Those who recognize patterns instead of reacting to noise gain the ability to move with intention rather than emotion. This is where smart money operates, quietly, methodically, without the need for validation. The most important shifts often occur before the public senses urgency. By the time fear or excitement dominates headlines, the groundwork has already been laid. That is why understanding the underlying structure matters more than predicting price movements. It's about recognizing when conditions align, when pressure builds, when confidence changes hands, and when the balance between risk and opportunity begins to tilt. These moments don't announce themselves loudly, but they reshape markets for years to come. What we are witnessing now is not a sudden event, but the early stage of a broader transformation. Financial systems are adapting, priorities are being reassessed, and capital is repositioning with intention. Those who remain observant, patient, and informed will navigate this shift with far greater clarity, not because they can see the future, but because they understand the present. In times like these, the most powerful advantage is awareness. Awareness of cycles, awareness of behavior, awareness of how markets truly move beneath the surface. This is not about predicting tomorrow. It's about understanding today. And when the next chapter fully unfolds, those who paid attention early will recognize that the signs were always there, quietly shaping what comes next.